How to calculate pips in Forex. Picture this. You just made your first Forex trade. The charts are moving in your favor, and you're feeling pretty good about yourself. Then someone asks, how many pips did you make? And suddenly you're staring at them like they just asked you to solve quantum physics. Don't worry, we've all been there. Understanding pips is like learning to ride a bike in the Forex world. Once you get it, you'll wonder why it ever seemed complicated. What exactly is a pip anyway? A pip, which stands for percentage in point or price interest point, traders love their acronyms, is the smallest price movement in a currency pair. Think of it as the Forex equivalent of cents in your pocket change. For most currency pairs, a pip is the fourth decimal place. So if euro to US dollar moves from 1.1050 to 1.1051, that's a 1 pip movement. Simple enough, right? But here's where it gets slightly more interesting. Japanese yen pairs are the rebels of the Forex world. For pairs like US dollar to Japanese yen, a pip is the second decimal place because the yen trades at much smaller values. So if US dollar to Japanese yen moves from 110.50 to 110.51, that's 1 pip. It's like the yen decided to be different just to keep us on our toes. The basic pip calculation formula. Now, let's get into the meat and potatoes of pip calculation. The basic formula is surprisingly straightforward. The calculate pip value function takes 3 parameters: currency pair, lot size, and account currency. It first determines the pip location by checking if the currency pair includes JPY. If yes, it uses 0.01 second decimal, otherwise 0.0001 fourth decimal. The function then calculates the trade size by multiplying lot size with the standard lot size of 100,000 units. Finally, it calculates the pip value by multiplying pip location with trade size and returns the result. The example usage shows how to call the function for euro to US dollar and US dollar to Japanese yen pairs and log the results. Breaking down different currency pair types. Currency pairs fall into 3 main categories. Direct pairs, USD is quote currency euro to US dollar, pound sterling to US dollar, Australian dollar to US dollar. These are the friendly neighbors of Forex. Indirect pairs, USD as base currency US dollar to Swiss franc, US dollar to Canadian dollar, US dollar to Japanese yen. A bit more complex, but still manageable. Cross pairs, no USD involve euro to pound sterling to Japanese yen, euro to Australian dollar. The wild cards that keep things interesting. Real-world examples that actually make sense. Let's say you're trading euro to US dollar with a standard lot, 100,000 units, and the pair moves from 1.1050 to 1.1070. That's a 20 pip movement. If each pip is worth $10, which is standard for euro to US dollar with a $1 lot size, you've just made $200. Not bad for a day's work. But wait, there's more complexity when dealing with different account currencies. If your account is in British pounds but you're trading euro to US dollar, you'll need to convert that pip value using the current pound sterling to US dollar exchange rate. It's like doing currency conversion at the airport, but with more zeros involved. Quote, the key to successful Forex trading isn't just knowing how to calculate pips. It's understanding how those pips translate into real money in your account. Every pip has a story, and every story affects your bottom line. Professional Forex trader. Advanced pip calculation scenarios. Now let's tackle the scenarios that make your head spin. Cross-currency pairs are where things get spicy. When you're trading euro to pound sterling and your account is in USD, you're essentially dealing with 3 currencies at once. It's like trying to juggle while riding a unicycle. Possible, but requires practice. The calculate cross-pair pip value function handles advanced cross-currency calculations with 5 parameters: base currency, quote currency, account currency, lot size, and current rates object. It determines pip location using a ternary operator, checking for JPY pairs. The function calculates the base pip value by multiplying pip location with trade size. The complex part is currency conversion. If quote currency differs from account currency, it creates a conversion pair string and looks up the rate in current rates. If found, it multiplies pip value by conversion rate. If not, it tries the inverse pair by swapping currencies and divides by inverse rate. The function returns an object containing the calculated pip value, rounded to 2 decimals, the account currency, and a calculation string. The example demonstrates usage with a market rates object containing current exchange rates for major pairs. Common mistakes that'll cost you money. Avoid these costly calculation errors. Confusing pip location for JPY pairs. Remember, it's the second decimal place, not the fourth. Forgetting to account for your account currency when trading cross pairs. Mixing up lot sizes. A mini lot is 10,000 units, not 1,000. Not updating exchange rates for cross-currency calculations. Assuming all brokers use the same pip value standards. Some use fractional pips. Fractional pips, the plot thickens. Just when you thought you had it all figured out, the Forex market throws you a curveball. Fractional pips, also known as pipettes. These are the 5th decimal place for most pairs, 3rd for JPY pairs. It's like splitting a penny into 10 pieces. Technically possible, but you need good eyes to see the difference. Many modern brokers now quote prices with fractional pips. So euro to US dollar might show as 1.10503 instead of 1.1050. That extra 3 is a fractional pip. While it might seem insignificant, when you're dealing with large position sizes, those fractions add up faster than compound interest on a credit card. Practical tips for pip calculation success. Here's the reality check. Most professional traders don't sit there calculating pips manually all day. We live in the age of trading platforms that do the heavy lifting for us. However, understanding the mechanics behind the calculations is crucial for several reasons. First, it helps you verify that your trading platform is calculating everything correctly. Trust but verify, as they say. Second, it gives you a deeper understanding of how currency fluctuations affect your positions. And third, it makes you sound incredibly sophisticated at trader meetups. The most important thing to remember is that pip calculation is just one piece of the trading puzzle. You also need to consider spreads, commission, swap rates, and that little thing called market volatility that can turn a calm Tuesday into a roller coaster ride. Quote, understanding pips is like learning to read music. Once you know the language, you can appreciate the symphony of price movements and make informed decisions about when to dance and when to sit out. Market analysis expert. Remember, the goal isn't to become a human calculator, but to understand the mechanics well enough that you can focus on what really matters, making profitable trading decisions. After all, you could calculate pips all day long, but if you're consistently picking the wrong direction, those calculations won't help your account balance. So there you have it, pip calculation demystified, with just enough complexity to keep things interesting, but not so much that you need a PhD in mathematics. Practice with small amounts, use the tools available to you, and remember that every expert was once a beginner who probably asked the same, how many pips did you make? Question that started this whole journey. Enjoyed this video? Hit the like button and subscribe to stay tuned for more.